Hello, everyone, and welcome to the Binance podcast. My name is Wee Zhou. I'm the host for this show. In my daytime job, I'm the Chief Financial Officer for Binance. For those who do not know, Binance is a blockchain company and operates one of the biggest cryptocurrency exchanges in the world. We also are helping to build a bigger blockchain ecosystem with other key initiatives and investments, including Binance Labs, the Blockchain Charity Foundation, Binance Info Academy, as well as Trust Wallet and Travel by Bit. For me, I joined Binance from the traditional financial world, where I served as the Chief Financial Officer for several Chinese and American companies, two of which were listed on NASDAQ and the New York Stock Exchange. I started off my career in investment banking with Goldman Sachs. From my personal background, I was born in China, grew up in the US, and did university at Harvard. After graduation, I pretty much moved around Asia and the US, between Hong Kong, Beijing, LA, and Singapore. Since I've joined Binance, I basically have witnessed a lot more people who are becoming more and more interested in blockchain and cryptocurrency. And that interest comes not just from simply buying Bitcoin or trading, but from a deeper interest. So what I want to do with this show is to spend time talking to specialists, entrepreneurs, scholars, influencers, basically leading people from a variety of industries. One of the first guests I talked to is Helen Hai. She came from a social development and charity background. I will also be spending time with people from politics, entertainment, gaming, advertising, just a variety of background, and talking about blockchain technology. Hopefully through these conversations, we can share insights on how blockchain is changing not just these different industries, but also in changing the world. Here's a quick disclaimer. All opinions expressed by our host and our guests on this podcast are merely their own opinions. They do not imply any endorsements or opinions of their companies. You should not take these opinions as specific investment advice, as you will be solely responsible for your own investment. So thank you everyone for joining us. This is Wee. I'm here with Thomas Lee, who's the founder and the head of Fundstrat, which is a very unique research institution that has been dedicated to analyzing all things crypto from a valuation perspective. Tom joins the blockchain community from a very long background in equity research on Wall Street. And we're really happy to have Tom here to educate myself as well as our listeners on his thoughts on all things from a valuation perspective. How do you value things within the blockchain space? Thank you for joining us. So Tom, I think a lot of our listeners don't see you commenting on CNBC and Bloomberg about all things Bitcoin, but I don't think they know sort of your background in terms of your previous life before blockchain. Can you tell us a little bit about that?
Yeah, I'd be glad to. So I've been doing research for financial markets since 1993, so over 26 years. And, in 1993, the reason I pursued equity research was, I went to Wharton as an undergraduate, just a business school at the University of Pennsylvania. But financial services and especially sort of stock research was a very personal interest of mine. And part of it was because my father was a doctor and fairly successful, but I feel like he got exploited by his brokers with his retirement savings. So, I think growing up, there was always this ongoing feeling that his brokers were stealing money from him or, getting him to buy things that lost him money. And so as a consequence, he was very suspicious and skeptical of financial markets. And so I went to business school. I wanted to be a business guy. And I think, the reason I was really attracted to research was it's kind of an area where you can be truly authentic. In stock research, you really only benefit if you can help your clients make money. So it's very personal for me to do financial services and stock research. But it was also really a big interest of mine. So I was really lucky. I mean, I think luck plays a huge role in everyone's career. But I was very lucky because in 1993 I graduated from Wharton and I got a job covering the telecom industry in the equity research area, which was booming at this time. So telecom was just beginning to get deregulated in the U.S. Plus, wireless communications was a brand new industry. At the time, there were only 34 million cellular phone users in the world. Today, there's 5 billion. But fortunately, my boss gave me a lot of independence, and I started to sort of write about the wireless industry.
Where did you start off your career?
My first job was at Kidder Peabody, which is it's a defunct broker dealer, but it was one of those original white shoe investment banks, but was really known for great stock research. And I spent a couple years there, and then I went to Smith Barney, which was another really well-known stock shop, but which got acquired or which ended up merging with Solomon Brothers. So I essentially, people consider me like a Solomon Brothers guy. And I did that for a few years and did a lot of IPOs. But then in 1999, I moved to JP.
So you were right there at the cusp of the dot-com boom in 95, 97-ish with the Netscape IPO and all.
Exactly. So I was in the middle of the massive internet boom, telecom boom, wireless boom, raising a lot of money for a lot of companies. And, my boss at Solomon Brothers is Jack Grubman, who was at the time one of the most famous telecom analysts. And I think one of the lessons I learned back then was, one, as a young person, because I was, again, very lucky. I became a managing director at Solomon Brothers before the age of 30. So I was one of the youngest managing directors at Solomon. Yes. Was that being young when there's new technology is a huge advantage, because I was able to sort of see this industry with fresh eyes, like older folks and my clients who are in their 40s kind of viewed wireless as a sort of a hobby business or something the telecoms were going to eventually make for free because they wanted to protect their long distance and landline business. And similarly, internet, which was booming at the time, was kind of viewed as like this, a business that made absolutely no sense, because a lot of the incumbent players and a lot of the investment bankers kind of didn't understand how large companies like Walmart, Sears would give away their business to these new internet startups. So I think, being a young person, I could really see the utility. But I think one of the smart things I did back then was I never really tried to pick winners and losers. So I think, my advantage being young at the time was to realize that, look, the landscape was changing, but it was, I had no idea who was going to actually be the ultimate winner.
But at that point, I think you had the same group of Wall Street and institutional investors who've been buying. I remember GE was the big buy back then, right? GE, Walmart, IBM, even to a certain degree.
Cisco.
Yeah, Cisco, the networking folks, the infrastructure guys, right? And sort of like the internet companies really didn't take off. I think it was maybe it was the Amazon IPO. It was basically sort of like you can buy anything, right? And then Excite and all the search engines and the browsers and all of that.
Yes. And looking back, it was a very confusing time.
It was confusing and exciting, because I remember I started off my undergrad. I did my undergrad at Harvard. I started off my undergrad in 1997, and then that's when we were having trading competitions in my dorm with our fake portfolios. And then I remember like AMD, Intel, Cisco, AOL, those are sort of the big names that we looked at every single day.
Yes, that's right.
But the thing is I just remember, because one of the biggest trend that I see here as a little bit relevant back then is that there was an alternative in terms of career choices for the first time for kids at for kids at smart schools. Because before, I remember it was basically consulting, banking, or grad school. Doctors, lawyers, bankers, or consultants. Those are probably like the top 4 professions choices. And then there's this thing that you can go to Silicon Valley or you can do a startup in your dorm. That was when college campuses were plugged into Ethernet for the first time, sort of like 95 to 99 sort of ish. So that was when we first sort of had the first wave of dorm startups.
That's absolutely right. I know at Solomon Brothers, with their recruiting classes, they were trying to hire analysts from undergrad. They relaxed the dress codes, and they genuinely felt they were competing with startups, that they wanted to make, hey, you could be doing a 2-year analyst program at an investment bank. It's just as cool as working at a startup. So you're absolutely right. They were competing for mind share and talent at that time because people just saw all the opportunity in the dot coms.
Mm-hmm. Yeah, and then one parallel that I kind of draw to today is that, like, sort of because I haven't been back on campus for a while, but just from looking at where my classmates were, a lot of them were at Facebook and Google, and I feel like these are kind of like in addition to working at investment banks, I think working at a Facebook or Google is sort of like on par with trying to get a job at Morgan Stanley or Goldman today.
That's right. I mean, exactly. If someone's a CS major today, the top tier opportunity out of school is to work at Facebook and Google. I mean, those are the jobs people who are computer science majors really covet.
But the thing is that now it just feels like the alternative, because back then I think even when the startup, I think it was predominantly a U.S. based phenomenon, with some in Asia, primarily I think in Japan, almost not really in China. Even if it is China, it's precluded to Chinese overseas students in the U.S. that are going back to China. I remember back in the day, in like the late 90s and the early 2000s. And it didn't really exist, I think, in a continent like in India or like in Europe to a lesser degree. But I feel like within the blockchain space now, the pervasive of it on a global basis, it's very, very different. I think that's probably something that I've seen that's very, very different.
Yeah, I mean, I'd say that's exactly right. In the 90s, there was kind of a U.S.-centric development, as you point out, because even though Japan had a lot going on with NTT Docomo and HSPDA was their standard, and PDC, Personal Digital Cellular, those standards weren't adopted in the U.S., and they weren't part of the European development protocols, which was GSM. So, you had really regional development, but, the bulk of sort of those internet stories, startups were all US based in Silicon Valley. And you're right, today, I wouldn't make that same observation. I think Asia is really one of the big centers of innovation for crypto.
And can you walk me through then sort of like, I think we all remember the NASDAQ, the boom, and then the crash, and then sort of the revitalization of tech becoming more household names on sort of Wall Street and from a research. How did you navigate that in the subsequent years?
Yes. So it was a long enough period where internet and tech was doing so well that people started to believe it was an everyday occurrence, because the tech boom and internet boom really started, let's say 95, 96, and it lasted nearly 5 years. So for 5 years, anybody could buy a stock in tech and very likely triple their money, within 3 months. And in fact, as an analyst, I used to get complaints from our salespeople because they'd be like, "Oh, Tom, you got a buy rating on the stock, but you only have 20% upside." They're like, "We can get 20% in a week. Why would I buy the stock?" So, yeah, the institutional community got really accustomed to making ridiculous amounts of money, and of course, it created a bubble. And I think at the time, again, being young, I didn't have necessarily a lot of foresight, but I did have, two things that was really helpful to me. One was I had fresh eyes, so I could see how there was a lot of disruption taking place. But the second was I had a background as a finance major at Wharton. So to me, I could see that there was a huge variance between what these stocks were valued at and how I would traditionally value companies. So I knew something was kind of didn't make a lot of sense, but I was also kind of young enough to realize, hey, look, there's something big changing here. And I feel very lucky because at the bubble peak, I knew something was a little odd because, again, I was at Solomon Brothers and just moved to JP Morgan. And I think to me, what really struck me was there were a lot of people making a lot of money so quickly, but they didn't really understand why they were doing so well. So I think it was the lack of self-awareness. And I think it maybe personally shielded me because at least I felt something was didn't make as much sense. And looking back, the names that people really thought were going to be the big winners didn't ultimately turn out to be the survivors. I mean, I think very few people would have picked Amazon as a long-term winner, but that was obviously one of the big names to survive. I think people were much more interested in things like, we were talking about like urban fetch, which was like local delivery, or like, pets.com. And, it was a really strange set of stocks people thought would survive, and it turns out none of them did.
Uh-huh. Or barnesandnobles.com.
Correct. That's right.
So from sort of covering internet and then traditional equity, how did you sort of make the move into blockchain and Bitcoin? Or how did that migration happen or evolution take place?
From technology, which is my sort of background at JP Morgan, from 2000 to 2003, a lot of my companies that I covered began to have financial problems. And so I started to do research on capital structure and bankruptcies. And in fact, at the time, JP Morgan had just opened a Mumbai office, so they were outsourcing research out in the Far East. And I worked with a big sort of legion of 7 analysts out there who were combing through bankruptcies. And it turns out we studied like 2,000 bankruptcies at the time, and I kind of came to the conclusion that stocks that are in bankruptcy under the right conditions are massive equities, So we wrote this report called Chapter After Chapter 11, which was one of the first ever on Wall Street research on bankruptcy, post-reorg stocks.
So one of the original big data analysis in equity research.
Correct. And in fact, Professor Altman at Columbia liked our research so much, he heavily actually quoted our research in some of his books and studies. And so JP Morgan asked me to say, hey, Tom, in addition to doing wireless, would you consider doing small cap strategy, because bankruptcy research really falls into small cap strategy? So I said, sure. So I was writing research in 2 categories. And then in 2007, our chief equity strategist left and went to another firm, and they asked me if I wanted to go from being a small cap strategist to being the chief equity strategist for the firm. So I said, sure, it's something new. So I became the head strategist at JP Morgan, and that's in 2007, which was, of course, a crazy time to be covering global market. Around 2009, our FX team at JP Morgan started to talk about FX markets, but then John Normand had mentioned something about Bitcoin. I'm an equity guy, and he's running from an FX perspective. And around 2012, he started writing some ongoing research, but he kind of concluded that eventually Bitcoin probably becomes a currency pair. So he thought it was something that was going to be real enough that people would write about. But the caveat was, he thought that the addressable market for that was essentially, dark web, Silk Road, drug dealers. And so it was something as a strategist, I didn't pay much attention to. But, come 2014, I left JP Morgan to start my own independent research firm called Fundstrat. We started to sort of write thematic research. And it's really there that we began to explore crypto, not as a currency, but really just as a technology. And I think that's when our eyes were really open, because I think the first time my team and I really spent time looking at Bitcoin, we realized, look, first of all, this is pretty ingenious solution for solving a lot of the problems with, double spend and fraud and encryption. But it was also, arguably a pretty good argument for digital gold because of its scarcity. And so that was our original sort of vector and approach into writing about Bitcoin. And, since then, we've been writing, to the extent we can, ongoing research, really thinking about Bitcoin, not only as a sort of a technology that's really important from a sort of helping re-architect the financial system, right? I think at the end of the day, it's probably one of the blockchain and cryptocurrencies are one of the real true alternatives to really replumb financial services, which is a very oligopolistic business. But we also think it's going to ultimately emerge as a true asset class.
Before we sort of jump in a little bit, can you let us know a little bit about Fundstrat? This is your own research house that you founded in 2012, 13-ish. And can you give us a little bit overview of this business today?
Yes. So Fundstrat is an independent research firm. The name Fundstrat is a combination of the word fundamental strategy, and that's really our approach. We're a bottoms up independent research firm. We write about markets, including policy research, so government policy. Our head of policy is Tom Block, who was head of JP Morgan's government relations for 25 years. We write technical analysis, which is led by Rob Slimer. He's our TA. He came from RBC Capital Markets. We have quantitative research, which comes from Sam Doctor, who came with me from JP Morgan. And then I focus on portfolio strategy, which is really thematic work. And again, I'm from JP Morgan. We have clients in 16 countries. Almost all of our clients are solely hedge funds and mutual funds and family offices. So it's primarily an institutional business. I think that's our footprint today. 5 years from now, I think we're going to be much more broker friendly, individual investor friendly, because that's really my passion again. Because again, to me, I kind of want to democratize research. I think of my father, and I always try to write research so that my father could understand what I'm saying. That's part of the sort of ethos of what we do.
One of the things we say here at Binance is DYOR, do your own research.
Yes.
People ask, you don't have to buy it. I mean, that's sort of the gist, right?
Yes, that's right. And with crypto, it's especially true because it's a hyper volatile asset class, right? I mean, in the long term, it's rising, but in the short term, it's a lot tougher to sort of understand short-term price changes in crypto than it is in equities or futures or bonds or credit.
Yeah, I mean, I'll jump in right here in terms of a couple of the themes that at least I have seen is that one of the key things that you've mentioned from back then is sort of how do people make bets on the sector without having to go out and pick individual winners? I think that's probably the hardest thing, right? Because I think one of the things that you just mentioned before was that a lot of the winners that everyone sort of had consensus on back then didn't really pan out. Right. Whereas, guys like Amazon, which is kind of one of someone in the pack, ultimately became a winner. But as a sector, it grew. Right. And I think from an investor's perspective, you're like, okay, I really love this sector, but it's going to be really hard for me to pick out winners. So what should I do as an investor then?
Yes. And I think that's a really important nuance to appreciate because most people, when they buy stocks, generally want to get their stock selection percentage correct, 50% of the time or 60, right? So their idea is, hey, listen, I'm going to use my skills to try to pick winners half the time. But when you're talking about a hyper growth industry where there's rapid evolution, then that approach actually typically fails, because it's impossible to pick winners and losers. And so one of the things that we highlight within our research for our clients is that when you look at sort of 10-year thematic trades, whether it's the 1980s or the 1990s or the 2000s, getting the right vector right, so identifying a hypergrowth area allows you to be correct only 5% of the time. So you could have 95% of your picks go to zero, but those 5% ideas generate sufficient return that you're actually beating the overall market. And so I think that that's true with crypto, that today in rough terms, there's only at most, I think generously 5 million wallets, maybe 50 million, but really 5 million true users of crypto globally. And yet there's 5 billion Visa and MasterCard wallets. So there's 1,000x increase happening in people who are using crypto every day. That's a 1 million times opportunity for the market cap of crypto. So I think people who buy crypto shouldn't try to say, hey, I know which protocol is going to be the winner. They should sort of approach it, as you said, through a basket and realize that, hey, look, 5% might be the long-term winners, but the percentage gain they're going to generate is so big that you're gonna have done well as an asset class.
That's a really good point because it's sort of like VC investing then, right? Like you have one Uber or one Facebook in your portfolio, and that makes up for all the other dollars that you might have invested in.
That's right. In fact, I was talking with our client about this tonight that, you could have had made 400 investments, but your one investment in Uber generated so much return that you didn't care what happened to the other 399 investments.
And then in terms of like one stat that you mentioned is super interesting is basically right now in the world there's maybe 5 million active wallets, right? Just call it those are and vis-a-vis sort of like bank accounts or what is it? What you said, Visa or Mastercard is 5 billion market size for that, or 5 million,
Correct.
5 billion accounts. So I mean the potential
right.
the potential there is tremendous. Then if you think of it, just
That's right.
and that the use case there is just purely wallet as a storage and a payment solution outside of the other potentials.
That's exactly right. And and in 10 years, because of population growth, there'll probably be 7.5 billion wallets. So even though there's only 5 billion today, the addressable market is still growing, so that in 10 years at 5% a year, it's 50% bigger. And I agree, because at the end of the day, the most successful cryptocurrencies or digital assets have been the ones that have been the most useful, the ones that are being used every day by people. So it's proof that if the whole market is going to grow, it's going to grow the value of cryptocurrencies.
Mm-hmm. And then I'll pop sort of like two questions. One is I'll continue this sort of like this thought analysis on the size, and this is something that you and I chatted a little bit briefly about. Is something that I mentioned I think a couple of weeks ago. It goes back to sort of the crypto wallet idea that you mentioned, which is that I think you mentioned there's like 5 billion cell phone users. There's probably more cell phones out there in the world than bank accounts. And it's very natural to think your cell phone then becomes that wallet and becomes that identity device that's all in one. And the continent that's been a passion project for Binance has actually been Africa, with basically the fastest growing demographically, as well as underbanked, right, which with only about 20% have been banked to. And then from a financial inclusion perspective, there's more probably cell phones there, ownership perspective, than bank accounts. There's a tremendous amount of potential there, whereas people can grow up with their first introduction to financial services maybe crypto rather than fiat money or just traditional banks or banking cards. Because I think in most developed society, other than China now, is actually people are switching with sort of the payments on their phone rather than using cards now. Whereas I think in Africa, maybe you don't need cards anymore. Everything is done on your phone. And
Correct.
Crypto is actually the native currency then maybe. I don't know if you have any thoughts on that.
Yeah, I do. I mean, one is, I think banks today have excessive power relative to the services they provide to customers. We've done a lot of studies on this using OECD data, but banks today earn about 6% of global GDP. That's with record low interest rates. That's nearly double the percentage it was 50 years ago. So even though interest rates were double digits 50 years ago, banks make more money as a share of GDP than they did a decade ago. And yet, I don't think banks are in the best position to understand their customers, both from a credit perspective or understanding, who's a good credit and who to lend to. And mobile phone companies are arguably in a better position. As you mentioned, there's, one, they have a much better idea of how people use their phones and where they're using it. And even social media companies, to the extent that they're careful how they monitor customers, probably have a much better understanding of credit, the credit profile of their customers. In fact, I know one of these cell phone lenders had told me that one of the single best metrics for default on a loan that they found was the percentage battery life remaining on the phone. And they found that customers who let their phone routinely die were the most unreliable credits.
That's an amazing correlation.
Yeah, they said it's a 99% correlation. So basically, a cell phone company can make a better decision about lending to you than a bank could. And as you point out, especially in countries like Africa where financial inclusion matters, people are more likely to have access to advanced telecommunications than they are to advanced financial services. So I think it's really important for a sort of parallel financial system to develop that allows people to access banking services without risk of double spend, that doesn't necessarily have to run through traditional banking architecture.
Then it comes to how many of your peers on Wall Street feels the same way, and what are they doing about it?
Yeah, and it's a very tricky line for us to navigate because I would say our clients in general are mostly in the U.S. They've done exceptionally well financially, but that means that they're a big fan of the legacy financial system, and for the most part, for them, crypto looks like a renegade, rebellious type of financial architecture that's somewhat rogue from a regulatory perspective, and most of them really want to see crypto fail. Now, of course, they'll change their minds because anytime you see a new technology, incumbents would like to see the new entrant fail.
But I think if that's the case, then has sort of like the rally in Bitcoin and the resilience of Bitcoin, at least from, as you mentioned before, as a new asset class perspective, has greed taken over yet? Or are we just sort of at the beginning of the beginning? Because I think ultimately these guys, yes, they want to see new things fail, but they've also been driven by greed, right? And I think that's been the constant swing between greed and fear, right? That's sort of how Wall Street operates. Has that taken over, or are we about seeing the beginning of that? Yesterday, your comment about $10,000 Bitcoin price being the start of FOMO, that's sort of like, say, ranked on a 10 out of 10 on a greed scale, right?
Yes, that's right. And that's exactly right. At the end of the day, Wall Street, if there's a known asset class and they believe they can have an edge, they're going to be quite interested in investing in it because, Wall Street has the ability to marshal a lot of resources to develop either a fundamental edge or trading expertise and make money. So you're absolutely right. Like, at the right tipping point, and it's either going to be because the size of the blockchain or the size of the crypto market itself, Wall Street's going to suddenly say, hey, look, I don't care if I understand exactly what's happening, but if I can make a lot of money, let's go ahead and do it. Because, that's the story of credit default swaps. Credit default swaps was originally just a spreadsheet on Excel, and it was a gambling bet, and now more CDS is traded than cash bonds. But what's really going to get Wall Street interested is really Bitcoin. And I think Bitcoin really is sort of central to the case. Bitcoin has to make people believe that it can achieve all-time highs because no other blockchain can survive without Bitcoin prospering. And so, we published a piece and I'll make sure I send you a copy that says, hey, what's a way to quantify Wall Street FOMO? And the reason it matters is, when Bitcoin fell 85% last year, Wall Street basically said, hey, Bitcoin's broken and it's going to zero. And they have good reason for that because 80% of stocks that fall 90% never recover. So in their minds, the probability of Bitcoin going to zero was essentially 80% because it had already fallen 80%. But now that Bitcoin's back to 8,000, that represents, and close to 9,000, it's only traded at this level 5% of the days in its entire history. In other words, it's at a level that very few people have lost money owning Bitcoin here. And we set another threshold. We said, listen, FOMO really occurs when the price achieves a level that's only happened 3% of the time. So in past cycles, that level was $8.50 in 2011. Today, that number is 10,000 because Bitcoin's prior to today has only traded above 10,000 87 days. So if you think about in its 10-year history, there's only less than 87 days where Bitcoin's been below 10,000. So we said, once it achieves this level, every institution's going to realize, look, at 10, it's likely to go back to its all-time high, which is a double. There's very few things that can double. So I think FOMO truly gets triggered once Bitcoin hits 10,000.
So going from 10 to 20 is going to be fast and furious then.
Correct. In fact, we wrote about this like that. If you look at past cycles, when you get to that 3% threshold, the typical surge in the next 5 months is 200 to 400%. So if Bitcoin somehow manages to get to 10, it's very likely going to make a run to 40,000 within 5 months.
That's a very aggressive call. Because most people you talk to, they make 5-year calls, 10-year calls, but this is a 6-month call.
Yeah. So, and again, we're just looking at how markets reacted FOMO, and it ties into the halvening.
That's correct. Yeah, and who knows where the world is from a political, geopolitical, and economic perspective 6 to 12 months from now.
Correct.
Yeah, in terms of the uncertainty. Really enjoy the conversation. Really appreciate the time you've taken. From my end, I look forward to meeting you either in person, either at the next conference. If there's anything you need from our end, do let us know.
Great.
Really look forward to speaking again.
Great. Really, thanks, Wei. Bye-bye. Take care.
Bye-bye.
Bye.
Thank you for listening. I hope you enjoyed this interview as much as I did. And if you like this show, please share this episode on Twitter, Facebook, Telegram, WeChat, or any other social media platforms. Please don't forget to subscribe to the Binance podcast, and see you next time.